Hey, what's up, YouTube? All right, the committee has come out with their final tax reform bill. It does look like they've taken mainly the Senate bill as a template, the initial Senate bill as a template, and they made a few changes and improvements to it. So now what's going to happen is next week, the House and Senate will again vote on this final bill. And then if that passes, they'll push it up to the president for him to sign. As it stands right now, most likely it's going to pass. As far as I know, there's only two undecided senators, Republican senators. However, as I said in the previous video, the Senate can afford to lose two Republicans, and it would be a 50-50 split, and then Vice President Pence would come in and break the tie and pass it and still push it up to the president. So, and again, it will take effect for the 2018 tax year that you will file in 2019. So the 2017 taxes you're getting ready to file in a couple of months will not be impacted. It's going to be next year, 2018 taxes you file in 2019. All right, so getting into some of the numbers here. The high-level numbers for standard deduction, child credit, and this non-minor dependents, those numbers stay the same. What changes on a few of them is some of the back-end language. So for the child credit, initially $1,100 was going to be refundable of that $2,000. They've moved that up to $1,400 will now be refundable. $600 will continue to be non-refundable, but they did move that up to $1,400 being refundable. As far as the age, they're going to leave it as is at 16. So in order to qualify, your child cannot turn 17 during that tax year. They were going to move it up a year, but they left it as is. So the child has to remain 16 for the entire tax year to be eligible for that child credit. The child must have a valid Social Security number also to qualify now for that child credit. They don't need to have it for the non-minor dependent credit, but they do for the initial child credit. Now, again, just like in the Senate bill, all of these are going to expire starting in 2026. So 2025 will be the last tax year that they will be in effect. However, as I stated in the last video, if everything goes well, the Congress can come back to vote to either extend or make them permanent down the road. Now, one thing that was in the final bill that I did find pretty interesting is today 70% of taxpayers use the standard deduction. With this increase, now this Joint Committee on Taxation, which is a congressional committee, they estimate that 94% of taxpayers will now use the standard deduction. So that's a big jump from 70% all the way up to 94%, meaning only 6% of taxpayers, they estimate, are going to be impacted by the itemized deductions that we'll go ahead and go over now. So I guess the biggest change is going to be for the state and local tax. So initially they were only going to allow $10,000 for property tax. What they've done now is they have a combined, the $10,000 limit stays the same. However, they've combined that for all state and local taxes. So if you have a small property tax and then a high income tax, you can actually combine those numbers. And as long as they're below the $10,000 limit, you can go ahead and use them. So for those in California and New York and some other states or high income earners, you still will be impacted, but again, you can now deduct a total of up to $10,000 for all of your state and local taxes. The mortgage interest, it looks like they've kind of compromised between the House and the Senate bill. They're going to allow, and again, this is for new mortgages starting in 2018 to 2025, up to $750,000. The interest tied to that $750,000 will be deductible. Again, that's for 2018 to 2025. If you have a current mortgage or after, so in 2026, those mortgages will kind of revert back to that $1 million limit as it is today, again, unless they extend or make these changes permanent. The home equity loan interest, again, will still be repealed. That's still going away. Now, in the new bill, this final bill, I couldn't find anything around that threshold for capital gains on your primary residence going from 2 years to 5 years as far as staying in your home in order for that to come into play. I didn't find anything in there, so I'm not sure if that's going or if it's just going to stay at the current 2-year threshold. The estate tax, it'll remain with the previous Senate bill. It's going to stay in, but they're going to double the limit from 2018 to 2025, going up to just under 11 million will be exempt for the estate and death tax. As far as the alternative minimum tax, very few of you are going to be impacted. So I went ahead, this is the exact language from the bill. So if you do use this alternative minimum tax for those upper income earners, you can go ahead and read through here. They've adjusted some of the limits and thresholds. So feel free, I don't use it. So there's the information from the bill. As far as teacher supplies, they're keeping it as is with that $250 above line deduction for those teachers that actually pay out of pocket for some of their supplies. The medical expense, so they did drop it to 7.5% as far as anything over that of your adjusted gross income you can deduct. The language said it's only good for the first year, which would be the 2018 tax year, which was a little strange, but that's kind of what the language said. So that's going to be good for a year, and then it's going to revert back to that 10% limit. Now, they did keep in that elimination of the individual health care mandate, which is that Obamacare mandate to purchase insurance. That stayed in the bill as far as eliminating that, repealing that. As far as the tax bracket, so they did make a few adjustments here. So the first two brackets stay the exact same. That third bracket, the 22% bracket, is what has changed. So they've actually, from the previous Senate bill to now this final bill, they've actually moved up the limits a little bit, meaning some more of those middle income to upper income earners will have more of their income, their upper income, at that 22% instead of moving up into that 24% bracket. So they give you a little bit more. You'll have to pay a little bit less taxes on your upper income since they've moved up those limits. The other big change is going to be in these upper brackets. Is initially it was going to be to hit that 35%. It was going to be $1 million up to $1 million. Now it's only up to 600,000. So anything over 600 now moves up to that highest limit, which they have dropped down from 38.5 in the previous bill to 37%. So they've lowered the limit, but they've also lowered the rate as well. Now that in the red there, the 300,000, that's for married filing separately. That's the limit on those upper brackets if you file married but separate, which is a very few, smaller minority of you guys. All right, again, going back, those tax brackets, just like all the other stuff, are set to expire in 2026. So 2025 will be the last year again, unless they extend or make them permanent. Now, as far as your individual tax situation, so I left this in here from the previous video. So you can use your 2016 return, or when you file in the next couple months for 2017 taxes, you can use that return. There's really only going to be 1, 2, or 3 pages of your tax return that you need to look at for your actual numbers. If you do a 1040 easy, it's 1 page. If you do a 1040 standard deduction, it's 2. And then if you use a 1040 with itemized deductions, that Schedule A, it's going to be 3 pages. So depending on which one you do, there's up to only 3 pages that you need to look at to actually pull your numbers. I put some of the lines here that you could look on those forms to get that information to give you a better estimate as far as plugging in your numbers. So the first thing to look at is your standard and your itemized deduction. So if you currently itemize today, but you're on line 40 of your 1040, if that number is lower than the increased standard deduction, then you can go ahead and just start using the standard deduction. You no longer need to itemize if that number is below the increased standard deduction limits. Now, if you're above that and you still itemize, you need to check your worksheet A, your Schedule A worksheet. If your line number 9 is higher than 10,000, then you'd have to just only use $10,000. So those in California or New York, or if you have a very high income in those high tax states, most likely you will still be impacted. But again, it's going to be very few of you. Again, going back, there's only going to be 6% that they estimate are going to use itemized deductions going forward. So an even smaller amount are going to be impacted by this that $10,000 limit on state and local taxes. All right. Now, as far as that website I gave you guys in the last video, taxplancalculator.com, Maxim Lot has went ahead and updated that website, the calculations for the new numbers that just came out. So you guys can head back out there, plug in your numbers to redo them with the new calculations to see how you're going to be impacted. All right, so this is going to do it for this video. So again, keep the comments coming. Been some great discussions, some good examples, so keep those coming. I think my next video, what I'm going to do is a how-to on how to do your own taxes. Because that standard deduction is going to be increasing if this passes, more and more of you are going to be using that standard deduction. I can show you guys how to use some of the tools to go ahead and do your own taxes. If you don't want to this year, I'd actually recommend still using a tax preparer. If you've never done your own taxes, use a tax preparer this year for your upcoming taxes. But go ahead on the side, go ahead and watch my video, do your own taxes, and then kind of compare to see if you're right on, if you're close, or if you're exact. The following year, go ahead and give it a try yourself. Some of these tools are very simple. I've been doing my own taxes the past 4 or 5 years now. Once you understand where to pull the numbers, which for most of you are going to be from your W-2 for standard employees, you just pull numbers straight off of that form, plug them in, and then these tools spit out the information for you. Even if you itemize, which I have for the past several years, you can still do it even if you itemize. There's additional forms you need to look at, but all of these numbers have forms that you pull directly from. So in my next video, I'll go ahead and do a how-to on that. So stay tuned for that one. Again, thanks for all the comments. Keep them coming. And until next time, see you guys later.